Legendary investor Jesse Livermore once said, "The stock market is never obvious. It is designed to fool most of the people most of the time." But right now, the market isn't just fooling you, it's gaslighting you. Imagine you're at a bar. You order a beer for $7. Next week, it's $8. A month later, it's $10, but the glass is slightly smaller. You complain to the bartender, and he says, "What are you talking about? The stock market is at an all-time high. You should be happy." That is the middle-class trap in a nutshell. We are being told the economy is strong because the S&P 500, which is basically just 7 tech companies in a trench coat, is going up. But your real-life index, your eggs, rent, and insurance index, that one is screaming. Today, we're going to look at the math that proves you're not crazy and why the next 24 months will change the definition of middle class forever. To understand where we're going, we have to look at 1972. It was the era of the Nifty 50. These were the one-decision stocks: IBM, Disney, McDonald's. The smart money said you could buy them at any price because they were too big to fail. They were trading at PE ratios of 42x, 60x, even 90x earnings. People felt rich on paper, but underneath, the great inflation was brewing. By 1974, the party was over. The market crashed, but more importantly, the cost of living stayed high. We're seeing a remake of this movie. Today, our Nifty 50 is the Magnificent Seven. We've crowded 30% of the entire U.S. stock market into just a handful of AI and tech stocks. When everyone is standing on the same side of the boat, it doesn't take an iceberg to flip it. It just takes one guy to lose his balance. Let's talk numbers, because the math doesn't care about your feelings. Since 2020, the M2 money supply increased by about 35%. That is a staggering amount of new money. If you have 10 apples and I suddenly print 10 more Apple vouchers, your original voucher isn't worth an apple anymore. It's worth half an apple. The invisible tax is debasement. Housing. In 1970, the median house cost $17,000. The median income was $9,800. Ratio 1.7x. Today, the median house is $420,000. Median income, $75,000. Ratio, 5.6x. The trap is that the middle class is still trying to use the 1.7x strategy in a 5.6x world. We are told to save 10%, but when the hurdle rate of living is rising at 15% a year, saving is just a slow way to get poor. Wealth isn't being lost, it's being transferred from those who hold cash to those who hold scarce assets. Now here's the part that usually gets me demonetized. The US is currently adding $1 trillion in debt every 100 days. It's like a credit card bill that has gone sentient and is now eating the house. To pay the interest on that debt, the government only has two options: raise taxes, political suicide; print more money, the silent choice. They always pick option 2. This creates a liquidity trap. The stock market has to go up because the currency it's measured in is going down. If your portfolio went up 10% this year, but the cost of staying alive went up 12%, did you actually make money, or did you just lose it more slowly than your neighbor? So, what's the move? Is it over? Hardly. But the middle class as we knew it, the work 40 years, buy a house, retire on a pension group, is being phased out. The new reality is a barbell economy. You're either an asset owner or you're an expense. The great problem no one admits is that the game is rigged to favor scarcity. Real estate, sound money, high leverage skills like AI or specialized engineering. Don't be the person waiting for 1995 to come back. It's not coming. The goal isn't to save money anymore. It's to exchange your rapidly devaluing currency for things the government cannot print more of. The future isn't doom, it's just different. And in a world of infinite printing, the most valuable thing you can own is your own ability to think outside the herd. Stay casual, but stay sharp. Subscribe if you want to keep your head above water.